Imagine you have a friend who's been through the Great Recession of 2008. They're here to tell you what really happened back then, why it still matters today, and how its effects continue to quietly shape your financial landscape. The Great Recession of 2008 began with a crisis in the subprime mortgage market. Subprime mortgages are high-risk home loans offered to borrowers with poor or limited credit histories who would not typically qualify for standard loans. Financial institutions packaged many of these risky mortgages into complex financial products called collateralized debt obligations, CDOs, which were then sold to investors, leading to a widespread belief that the risk associated with subprime lending had been effectively dispersed. When housing prices began to fall and borrowers defaulted on their mortgage payments in large numbers, the value of these CDOs plummeted, triggering a global financial crisis. But then housing prices fell, leading to widespread defaults on mortgage loans. As a result, banks suffered significant losses, which quickly affected other institutions and financial systems globally, creating a "here's what you need to know." The financial crisis of 2008 began with subprime mortgage defaults amounting to hundreds of billions of dollars, contributing to the collapse of major financial institutions and a global economic downturn. That sounds like a significant figure, but it's still just a fraction of the total value of assets in the U.S. financial system at that time. When these subprime mortgage loans defaulted en masse in 2007 and early 2008, many banks faced significant losses and had to sell assets to maintain liquidity. This led to a widespread market panic as investors became increasingly worried about the solvency of financial institutions. Panic selling intensified as investors rushed to liquidate their holdings, causing stock prices to plummet. Now picture this: you're an ordinary person with a 401k or a retirement account. When the market crashes, like it did during the Great Recession of 2008 to 2009, your savings can drop significantly. Many people saw substantial losses overnight. And here's the kicker: even if you didn't invest in risky assets, the crash affected everyone's portfolios due to its broad impact on financial markets. The Great Recession of 2008 hit hard, causing unemployment to surge from around 5% to nearly 10%. This means that the number of unemployed individuals increased significantly, impacting many American households. People who retained their jobs often experienced wage cuts and reductions in benefits. This hardship extended beyond financial impacts, affecting mental health, relationships, and overall well-being. We refer to these broader effects as the human toll. So how did we get here? The Great Recession of 2008 had multiple contributing factors. Some blamed deregulation in finance, arguing that lax laws allowed for risky behavior. Others attribute it to the housing bubble and the proliferation of subprime mortgages that were unsustainable. The truth is probably a mix. But one thing's clear: financial crises like the Great Recession of 2008 have widespread impacts, highlighting the importance of robust regulatory frameworks in finance and the necessity for individual investors to manage their finances carefully. Now here's the real shocker: the effects of 2008 linger to this day. Think about it: if you're around now, perhaps your parents or grandparents lost retirement savings during that period. Maybe you know someone who still hasn't fully recovered from job losses or home foreclosures back then. The financial crisis of 2008 demonstrated the interconnectedness of global financial systems. Problems in one area can quickly escalate into widespread crises, affecting various countries and markets alike. So what did we learn? One big lesson is the importance of diversification. Do not concentrate your investment portfolio too heavily in any single asset or market. By spreading out investments across various types of assets, you can potentially reduce risk and protect yourself from significant losses if one area performs poorly. Another takeaway is the importance of having an emergency fund. During a recession such as the one in 2008, employment opportunities can diminish rapidly. However, if you maintain 6 months' worth of living expenses in savings, you're better equipped to handle financial instability during tough economic times. And here's something people often forget: it pays to be boring with your investments. Index funds, which simply track broad markets or specific sectors, generally outperformed most individual stocks and risky bets during the financial crisis of 2008 to 2009. The boring option quietly outperformed the exciting one time after time. Let's talk about some numbers. Here's a crucial fact: if you had invested $10,000 in an S&P 500 index fund right before the Great Recession of 2008, by the end of that year, it would have dropped to around $6,900 due to market declines during the financial crisis. But here's where being patient pays off. If you stuck with it until 2019, your investment would have recovered and grown to over $35,000 thanks to subsequent bull markets and long-term growth trends. Now let's look at fees. A common misconception is that small fees don't matter much in the grand scheme of things, but they do a lot. If you paid just 1% annually on your investments for 25 years and assumed an average annual return of 7%, the total cost would be approximately $63,000 for every $100,000 invested. Over longer periods, those little percentages can add up to significant sums. Another lingering effect, the Great Recession of 2008 changed how people view debt and savings. Post-recession, individuals began saving significantly more compared to the period before the crisis in the early 2000s. They learned that having cash on hand is crucial during economic downturns. But here's a twist. Despite increased financial awareness, many people still struggle with student loans and credit card debt today. It's a double-edged sword. We're more financially savvy yet remain vulnerable to financial pitfalls. The Great Recession of 2008 significantly changed perceptions regarding retirement savings. Individuals became more conscious of the risks involved with stocks and other volatile investment vehicles. As a result, there was an increase in interest towards less risky assets such as bonds, certificates of deposit, CDs, and holding cash in savings accounts. But remember, while it's wise to be cautious, it doesn't mean you should avoid investing entirely. Growth remains crucial for long-term financial goals, but it should be balanced with appropriate risk management strategies. The Great Recession of 2008 led to a wave of regulatory changes intended to prevent another such crisis. Laws like the Dodd-Frank Wall Street Reform and Consumer Protection Act aim to tighten controls on risky financial practices. Whether these regulations have been effective remains an ongoing debate, with some arguing in favor and others calling for further reforms. One area that received significant attention was mortgage lending. In response to the financial damage caused by subprime mortgages during the Great Recession of 2008, regulatory bodies implemented stricter rules for home loans. While these regulations made it more challenging for some individuals to purchase homes, they also contributed to a safer and more stable housing market overall. Here's a surprising detail. Even after the regulatory changes implemented in response to the Great Recession of 2008, the financial industry still manages trillions of dollars in risky investments each year. It's a reminder that while regulations can help mitigate risks, they cannot eliminate human greed or error entirely. The Great Recession of 2008 highlights the importance of staying informed and vigilant with your financial decisions. It underscores the need to conduct thorough research and think critically before making any choices. And here's a final lesson. Be prepared for unexpected turns in the market. A downturn can occur at any time, so maintaining a solid emergency fund and diversified investment portfolio is always wise. The Great Recession, which occurred from December 2007 to June 2009, highlighted the importance of prudent financial planning and preparedness in the face of economic downturns. Understanding and learning from such events can help individuals make smarter choices to manage their finances effectively during uncertain times. But here's one last thing. Remember, this isn't just history, it's a lesson for today. Every time you see the market shift or hear about another economic downturn, think back to 2008 and understand what really happened. It can help keep your financial decisions on track no matter what comes next. This is educational and historical, not financial advice. The Great Recession of 2008 highlighted the risks of banks engaging in excessive lending without sufficient reserves, much like building on unstable ground. Subprime mortgage lenders issued loans to individuals with poor credit histories who were unlikely to repay them, fueling a housing market bubble. When the housing market crashed in 2008, millions of people lost their homes and jobs. This highlighted the importance of having savings and emergency funds as a buffer against financial shocks. Today, living paycheck to paycheck can be financially precarious because it leaves little room for unexpected expenses or job losses. Understanding the value of financial planning and emergency reserves is crucial for personal economic security. The Great Recession of 2008 significantly impacted retirement savings. Many individuals were compelled to withdraw funds from their 401k plans prematurely, facing substantial tax penalties and foregoing potential investment growth. It's important to understand the benefits of leaving money in long-term retirement accounts to benefit from compound interest and market recovery over time. The financial crisis of 2008 led to bailouts that saved several large banks, which did not alleviate the financial struggles faced by many individuals burdened with debt. Often those with significant wealth may receive support during crises, while less affluent individuals face greater hardships. This situation highlights the importance of being financially prepared for economic shifts and uncertainties. The crisis highlighted the interconnectivity of global financial markets. Issues in one country can rapidly affect others globally, illustrating that economic challenges in one region can have repercussions around the world. Since the Great Recession of 2008, regulatory measures have been implemented to prevent similar crises in the future, but potential risks still exist. It's important for individuals to stay informed and protect their own financial health. Don't just follow the hype, do your research and think critically about every decision. The financial crisis of 2008 highlighted the importance of financial literacy for individuals to protect their wealth during economic downturns. Gaining knowledge about market dynamics can better equip one to navigate through future crises. Stay curious, continue educating yourself, and be prepared for various scenarios. This is educational and historical, not financial advice. In 2008, many people lost their jobs, homes, and savings overnight. It was a wake-up call for millions who thought they were financially secure. According to data from the U.S. Federal Reserve, about 1 in 4 homeowners saw their property values drop by half or more. That's like seeing your biggest asset cut in half. The crisis also exposed how risky some banks had become. They were heavily investing in complex financial products that few understood, leading to significant losses when the market downturn occurred. This situation is akin to playing a high-stakes game of poker with borrowed money, where one incorrect move can result in substantial losses. Since then, many people have recognized the importance of diversifying their investment portfolios and maintaining an emergency fund. An emergency fund has become a crucial component of personal finance planning. Consider this. In the event of unexpected unemployment, would you have enough savings to cover essential expenses for at least 3 months? The Great Recession of 2008 highlighted the power of compound interest in reverse, demonstrating how quickly debts can grow during difficult economic times. If you're carrying credit card debt, high interest rates make it very challenging to reduce your balance, as a significant portion of each monthly payment goes toward paying off accrued interest rather than the principal amount owed. Understanding these lessons is crucial for anyone looking to protect their financial future. It's not just about saving and investing, it's also about understanding how the financial system operates behind the scenes. Markets are complex and don't always behave predictably, but knowledge can help you navigate them more effectively. This is educational and historical, not financial advice.